All right, welcome to this week's episode of DoubleLine Minutes. I'm Jeff Mayberry with Ryan Kimmel.
Yo, yo.
It's just after 10 a.m. Pacific time here, April 11th. I was reviewing some of our monthly commentaries that written, for the end of the quarter this morning, and it said the start of 2025 has been turbulent. And I was thinking that we thought the first 3 months were turbulent, and then April, at least the first 2 weeks of April, I said, hold my beer. And we got a little extra turbulence here in April. So it's been I was going to make a joke about it's been a pretty long April, but it's only been 2 weeks. And it seems like it's been, so back and forth. But why don't we hop into the where are we for the week? And, if you look at it and you say, oh, S&P up 5.3% on the week, great week. Nothing to see here. As long as you went Friday to Friday, no big deal. A month to date, S&P still down 475 or so. But really, on that week, you have tech, the best performer, up 8.25. Looks like industrials up 6 and change as the second best performer, and financials up 5.25. Your worst performers, energy down 1.4%, and real estate down almost 1%. Everything else positive on the week. On month to date, though, a little bit of a different story. Staples, the best performer, up 2.3%. Utilities up 2.1%, the second best performer. So given that staples and utilities were your two best performers on a month-to-date basis, that kind of shows you kind of how the market has reacted so far on a month-to-date basis. But this last week kind of reversing a lot of that movement there. On the week, Russell 1000 up 5%, Russell 2000 up only 50 basis points. Russell 2000, a pretty big laggard here on a month-to-date basis, down almost 9%. Russell 1000 down 5%. And then look at growth value, growth up 7% on the week, value up only 3%. But kind of that's a reversal of, that's kind of played out also on a month-to-date basis with growth down 3.3% and value down 7%. Really no place to hide there on a month-to-date basis, but a week-to-date, you still have the NASDAQ up 7%, S&P equal weight up 2.6%, so good from both of those. And if we care, the old bear market correction, if we take everything from the highs or relative highs there of February 19th, S&P still down 13%, equal weighted S&P down 11.5%, and NASDAQ down 17%. So even though NASDAQ up 7% on the week, still down 17% from the highs there. So pretty volatile week there in the stock market.
Anytime you start the week with VIX at 60, you're going to be in for a wild ride,
yeah.
Right?
And it finally went up. It was so low for so long that it finally seemed like that vol finally picked up, at least on the VIX side of things.
And some of the daily moves we saw this week were pretty historic, have some interesting factoids. So on Wednesday, when Trump capitulated, I guess you'd call it, on the tariffs, that 9.5% surge we saw in the S&P 500, that was the largest single day move since 2008, and the NASDAQ was up 12% that day, which was the biggest daily move in 24 years. Which, ironically, as you're talking about, you tend to see these violent up moves during bear markets. While S&P hasn't officially entered the bear market territory, which is that the down 20% from the cycle high, the NASDAQ, though, that did enter bear market territory and pushed all the way down 24% from the December peak. So it is kind of playing out how you would expect if this is truly a bear market.
Well, Ryan, that's the old saying is nothing feels better than a bear market rally.
That's right.
And we certainly got that on Wednesday. And it was even better because the market was down so much in the beginning of the day and then rallied so much. It felt so much better. And then, gave some of that back on Thursday. And then today is pretty flat. So I think people are kind of over the vol. People are, worried about the Masters now. Just try to enjoy the weekend. So I don't think that we'll probably see pretty little vol, hopefully knock on wood here, pretty low vol for the rest of the day, and we'll see what kind of Monday holds from here. Yeah. But if we kind of shift over to fixed income markets, you talk about a lot of vol. On Monday, the 10-year was up 19 basis points. On Tuesday, 10-year was up 11 basis points. On Wednesday, the 10-year was up 4 basis points. On Thursday, the 10-year was up 9 basis points. And on Friday, the 10-year was up 4 basis points. Put that all together, and the 10-year was up a whopping 47 basis points on the week. We're now at, well, as of time of recording, 447 on the 10-year. The long bond was up 44 basis points, up to 485. It did touch 5% on Wednesday, and there's some conjecture out there that that 5% long bond was really kind of what spooked the Trump administration and kind of what led them to implement their 90-day delay on the tariff side of things. And really, when you look at it, that vol is pretty crazy, but it is unidirectional, at least up every day. 2-year up 26 basis points. So for those of you that can do that quick math there, the 2-year, 10-year spread widened or steepened by 21 basis points and is now at 55 basis points. The 230s got up to 100 basis points and it's down. It's up at like 94 basis points today. So pretty good steepening for a week there, Ryan. And that's kind of a trade that we've been liking, and something that has kind of come to fruition. And I think a lot of that, or there's that speculation that it is, the higher probability of a recession, higher probability of the Fed cutting rates, but also kind of what's going on in Congress on the fiscal side of things. Some more debt and a larger deficit has kind of caused the long end to rally, or long end to sell off even more, as what people are speculating out there today.
Yeah, I mean, the moves we saw this week in fixed income were actually like more extreme than in the equity markets to a degree. Like, just to put that weekly change in yields into perspective, like earlier in this morning, 10-year yield was up 52 basis points on the week. That would have been the largest weekly move in 24 years, and I think the second largest since the early 80s. And the 30-year was up like 49 basis points earlier in the morning, which would have been the largest weekly move since the early 80s. So definitely some stress in the long end. And as you mentioned, I think that's kind of really helped the administration pull back on the tariffs. Secretary Bessent, who's a pretty market savvy guy, former macro hedge fund manager, he probably gave Trump the shoulder tap and said, "Hey, we need to do something about this. We're starting to see some dysfunction in the bond markets." And I think what was interesting too is, like, you saw not only treasuries selling off and yields moving higher, particularly was that like Tuesday afternoon during the Asia markets, and that coincided with the dollar really coming under pressure, which kind of has the fingerprints of reserve managers selling of dollar assets, which definitely not something that as Secretary Bessent put it, he's the biggest sales guy of treasuries. I don't think he wants to see reserve managers selling
Right.
of
Yeah.
his assets. And you did start to see some dysfunction in the repo markets, Tuesday afternoon into Wednesday morning, and swap spreads really blowing lower. And there was talk of some like leverage basis trades getting unwound. So it seems like the administration is really, focusing on the bond market instability there.
Yeah, and I think things have kind of settled down. It doesn't seem like there's, too much vol here today. So maybe things will be calm over the weekend. But if we kind of focus on, I guess as we look at the rate moves, obviously your fixed income market did pretty poorly on the week. Ag down 2.5%. Looks like the big loser. Investment grade corporates down 3%. Agency mortgages down 2.75%, and treasuries down 2.4%. So treasuries the best performer there. Treasuries, or the ag, still positive on a year-to-date basis. It was a year-to-date, 10 years down 10 dips, 2 years down 33. And ag's up 1.1%, treasuries up 1.6%, agency mortgages up 1.2%, and investment grade actually down 35 basis points on a year-to-date basis. If we go to our non-index sectors, high yield, surprisingly only down 50 basis points given all the vol, and EM down 1.8%. Kind of that's more in line with what I would have expected from the high yield market. I guess high yield has a shorter duration, so maybe a little bit of that duration move is hurting EM, helping high yield relatively. And bank loans, the loan positive performer up 0.5%. A lot of that's obviously a fixed rate, floating rate, so not much duration there. It's not hit by that big move in duration over the week. So almost nowhere to hide there from the on the fixed income side of things in this kind of ripping stock market. And then finally, commodities turned in a positive week. We talked about vol, obviously commodities, a lot of vol there. Bloomberg Commodity Index up almost 2%. Looks like energy, the lone loser, and the kind of big sectors down 4%. You had WTI at 61.15 as of time of recording, with WTI crude down 1.7% on a week-to-date basis. It's a crazy number for the month-to-date. WTI crude oil down 14.7%. And we did see it actually worse. I think we saw a 58 handle on WTI at some point during the week, and kind of rallied back a little bit, but then you kind of got that double whammy of OPEC plus, as Mark and Eric talked about last week. Tariffs plus OPEC plus. Really, I think commodities are, they're showing the kind of lower demand side of things now, whether it's in your industrial metals, your energy, and even your ags and livestock. Precious metals, the best performer, up 7.5%, with gold up 7%. We're at 32.28 as of right now. And it wasn't that long ago when we were like, oh man, gold above 3,000, pretty crazy move. And now here we are at 3,200, and doesn't seem to be slowing down at all. And with that, that's kind of it for my macro roundup, or I mean, not the macro roundup, the market roundup. Ryan, why don't you hit us up on the macro side of things?
Yeah, well, the economic data this week really took a backseat to the tariff headlines, but we did get some interesting inflation data, which I will cover. To start off the week, we had a few interesting releases, kind of I'd call it, tier two data. You had consumer credit for February that showed a decline, which could signal perhaps some weakness in consumer demand going forward. We also had a decline in the NFIB Small Business Optimism Survey, which is in line with what we're seeing. The deterioration in other business sentiment surveys like ISM, services and manufacturing, and also in the consumer data, which we got an update this morning. We'll cover later. Um, but I think the key focus on the week, as far as the macroeconomic data goes, was the is the inflation data, which was by and large, I'd say pretty constructive. Came in softer than consensus, both the CPI and the PPI data. So for the month of March, you had the headline CPI come in down 0.1%. The market was expecting one 10 basis point increase. This brought the year-over-year number down to 2.4, down from 2.8. So a nice deceleration there. You also had the core CPI number, which excludes food and energy. That increased 0.1%, and the market was expecting a 30 basis point increase there. And when you look at the underlying sectors of the report, I'd say it was a pretty benign inflation report. You had what the Fed was really focusing on, the core services ex shelter, aka super core, that actually declined 24 basis points on the month, and brought the year-over-year number, pretty significant deceleration there. Decelerated just under percent to down 2.9% year-over-year, which was the slowest rate we've seen there since March 2021. Right before the big inflation surge that we saw. Um, you know, I think one kind of key element of this report was that the cyclical components. So like the, super core, which is I'd say more tied to wages, and like your um used car and truck rentals and lodging away from home. So, hotels and airfares, those are more demand driven. Those did show some deceleration in March. So perhaps, a bit of a, we're seeing a bit of a pullback in demand kind of feed into lower prices there. So the one negative from this report was in the shelter component, owner's equivalent rent that did spike up to 40 basis points on the month, up from I believe it was 20 bips the previous month. You can get a bit of volatility on the monthly data here, but that did not move in the right direction. And then this morning we had producer prices, which also came in lower than expectations for March. You had final demand that dropped 39 basis points month over month. The market was expecting a 20 basis point increase, and that brought the year over year number to 2.7%, which is down 0.5% from the previous month. So a nice deceleration there. And I think importantly, as we've talked in these calls in the past, economists, when they're modeling the PCE number, they take the inputs from PPI and CPI, and those components are pointing to a softish reading for PCE for the month of March, which we'll get in about 2.5 weeks. So, based on those inputs now, I think economists are forecasting flat readings month over month for both headline and core PCE, which based on that monthly reading would take the year over year core PCE reading down to 2.6, which would be the lowest levels we've seen since the inflation surge. So that would be encouraging. But obviously, this is a bit backward looking. We're heading into, uh, I guess what you'd call a tumultuous time for prices, just given the tariff impact and a ton of uncertainty on how you exactly model the price increases that we will see. So I think that's why markets pretty much discounted the data that we got, the inflation data that we got this week, is it's just kind of backward looking.
I think it's
Um,
interesting that like the numbers were so good that and obviously you couldn't there's probably some tariff effect in there, some slowdown, helping bring inflation down. But if we got these numbers in, in some of absent like kind of this tariff turmoil, as you said, I think that the market would be pricing in Fed cuts, the stock market would be ripping, that this would be like, okay, we got inflation under control, and now let's focus on the growth side of things, and just kind of the whole tariff outlook and the uncertainty around it has just put kind of a wrench in everything. And I think that when you look at it, if you had said that we were getting a flat PCE month over month, both core and headline, you know, the stock market would be up 5% easy that day. And you'd have Fed cuts being priced in kind of more normalized, that the Fed rates would be more normalized, and it would be, as you were about to talk about consumer sentiment, that consumer sentiment would be very positive, I would think.
yeah, how the world would look without a threat of tariffs. Yeah, so I think that's a pretty good segue into the final data point of the week, which was an update on consumer sentiment from the University of Michigan, their preliminary survey for April. And we saw consumer sentiment really continue its decline. It dropped to 50.8 from 57 the previous month. And when you look at like a 40-year chart, we're getting towards like the lowest levels you've seen. I think we've only been down at this levels in 2022, when we had peak inflation during the depths of the global financial crisis. So consumer sentiment is very weak at the moment. And when you look at the underlying report, the weakness is seen and the deterioration is seen across all the different segments, including age, education, income, political affiliation, just pretty broad-based deterioration in sentiment there. And so the key question is, will that eventually feed through into weaker consumption, which you haven't really seen yet. So the verdict is still out on that. And then I think the key component to highlight from the report was the surge in inflation expectations that we saw. We saw the year ahead inflation expectations jump to 6.7% on the month, which is the highest reading since 81. And then we also saw long run inflation expectations, which is looking out 5 to 10 years. Expectations, that rose to 4.4%, which is also, a multi-decade high. But I will caveat this, and I mentioned this, I think the last time I was on the call and this number was released, that you're not seeing this type of de-anchoring inflation expectations, at least using market-based inflation measures like break evens, which have actually started to collapse. If you just look at 5-year and 10-year break evens were, below the levels before the election. So um still a lot of uncertainty um just on, how these tariffs are really going to feed through into prices.
Well, that brings us to our Fed speak for the week, and obviously there was a lot of Fed speak, and they all kind of were the same point, saying we don't know, too much uncertainty doesn't really seem like they're going to cut rates anytime soon. But Goolsbee was out yesterday, and he's I think he's the Chicago Fed president, and he said, "quote A tariff is like a negative supply shock. That's a stagflationary shock, which is to say it makes both sides of the Fed's dual mandate worse at the same time. Prices are going up while jobs are being lost and growth is coming down. And there's not a generic playbook for how the central bank should respond to a stagflationary shock." And end quote. And so I think it's that's kind of where they're at. We don't know. I think Powell has said that the further they are away from whichever goal, or the goal, they have a 2% inflation target, strong labor market. So whichever one they're further away from, that's the one they'll focus on. And so I think that they're at a place where if you get higher, whether the tariff inflation is transitory or not, that's remains to be seen. But from that perspective, if we do get higher inflation right now off of tariffs, I think the Fed's going to focus on that and not really focus so much on the jobs side of things. And so really that's kind of markets kind of pricing that in. We have a 32% chance of a Fed cut in May. We got over 100% chance of a cut in June. So June seems like our first time of getting a cut, and it's been pretty volatile. So that's as of time of when I wrote these numbers down, and we're still at 3.25 cuts by the end of the year. Looks like June, September, December type time frame, so once a quarter there. So it doesn't really seem like the market is, or at least the Fed funds futures market is really playing on the Fed to kind of bail out the market. And I think that we've yet to see kind of a catchy phrase for what happened on Wednesday when the Trump administration kind of put their paws in, whether as like Trump blinked or but that's not really catchy enough, right? It's got to be something that kind of rolls off the tongue that people will remember. Kind of like Liberation Day, or people called it Obliteration Day. Those are catchy. So kind of see how over the next week or so whether someone comes up with something good for what happened on Wednesday or not. But with that, I mean, looks like next week from a macro standpoint, very quiet. Wednesday is a very important retail sales number. The month-over-month number is expected to be 1.4, up from 0.2. So it doesn't really look like there's any tariff-induced slowdown expected out of the retail sales numbers. We got industrial production on Wednesday also said to be down 0.2. We got import prices on Tuesday. That's expected to be flat. Ex-petroleum expected to be up 0.4%. So not too much to worry about there. Obviously, jobless claims on Thursday. So we'll see how that goes. And then Friday is a holiday for the stock market. So we will be recording, I think Mark and Eric will be recording the minutes at a kind of a new time, 10:45 Pacific on Thursday. But those of you that are, don't catch it live, they'll certainly be up for you to listen to afterwards. But just kind of due to scheduling conflicts and meetings and a short week, we'll be doing it at 10:45 next week. So, but I think that kind of wraps it up this turbulent week there, Ryan. I'd like to thank everyone for listening.
Yes, thank you all our listeners out there today on DL Minutes. Hit us up on X at DL Minutes or send us an email at minutes@doubleline.com with any questions, comments, or suggestions.
Yeah, we got a lot of YouTube content out there, youtube.com/doubleline capital. We have got Jeffrey Gunlock's CNBC appearance talking about tariffs. That was, as always, good. We have Morris Chen talking CRE, so definitely recommend listening to that. And finally, we have Jeff Sherman's webcast from Tuesday titled Reckless or Reckless. And that was on Tuesday before kind of the Trump administration decided to wreck less on Wednesday with their pause in the tariffs there. So thanks for tuning in. I hope everyone has a great weekend.
Take care, everyone.
This presentation was recorded on the date indicated. Views and opinions expressed herein are those of the individual and do not necessarily reflect the views of DoubleLine Capital LP, its affiliates, or employees.